In the next couple of episodes, we're going to be diving into underwriting. This episode, we're going to focus on one of the financial documents that you're going to look at within underwriting. But first off, what is underwriting? If you're a math nerd, you're going to love this. Underwriting is the magic sauce that tells you what your investment is going to look like and what kind of financial risk you're about to take on. We do this ourselves because, let's face it, we can't just take everything at face value. Real estate brokers are great, they're super helpful, but you always have to independently verify the information that's given to you. I cannot stress this enough. Trust, but verify. You cannot rely solely on the broker's documents or the seller's documents because at the end of the day, you're going to be putting all your eggs in one basket. That's a big no-no. We're way too savvy for that. And on top of that, we don't want to be shitty underwriters. If you're a shitty underwriter, you're going to buy shitty investments. And when you buy shitty investments, you're going to make shit money or actually lose money, which is the shittiest of all of it. It's pretty much going to be a pure cascade of shittiness. So when we were on due diligence, we were learning the importance of getting our hands on important documents like rent rolls, like financial statements, pretty much any and all documents that are pertaining to the property that speaks numbers. Now it's actually your time to actually put the analytical skills to the test. What we're going to do during underwriting is diving into numbers. We're going to analyze the data and we're going to make sense of the figures with precision. Before we get too far, we're going to have to hit the basics. We're going to have to dig into what financial statements are. So in today's episode, we're going to be looking at balance sheets. In the financial world, you're going to see three typical financial statements. Today, the first one, once again, is balance sheets. We'll go into the other two in a later episode. I know with financial statements, accountants and financial specialists, they're going to breeze through them. They're going to read them like it's a fifth grade book. While for some of us, like you and me, it's probably going to take a little bit longer. It might look like it's in a different language, but bear with me. I can't even tell you how many times I had to bug my accountant to actually look at these docs and explain them to me. But don't be intimidated. Like everything, it takes a lot of time. It just takes some time to learn. You're going to be a pro in no time after looking at so many of these in your real estate journey. So let's start off with the balance sheet. What the hell is a balance sheet? So the balance sheet is one of the three financial documents that we're going to run through. Imagine it as a comprehensive snapshot of a business's financial standing. So imagine you get to freeze a company's financial status at a specific moment in time. Now you have assets, you got liabilities, and you got shareholders' equity. That's probably one of the three main things that go into the balance sheet. They all converge in order to provide a glimpse of the property's financial strength and its ability to weather any market fluctuations. A lot of times when you're looking at stocks or public companies, they're going to show you what their balance sheet looks like because all that information has to be reported. So in this case, we're looking at it from a property's point of view. A balance sheet is a super valuable tool for understanding the company's or a property's book value. It's going to shed light on its available resources and how they were funded as of a specific date. It's going to offer a clear view of the company's assets, its liabilities, and the owner's equity. In simpler terms, it's going to tell us what the company owes, what it owns, and also the amount that's invested by shareholders. The equation for this is typically assets equal to liabilities plus the owner's equity or the shareholder's equity. Ideally, when you see a balance sheet, the assets have to equal the liabilities plus the shareholder's equity, meaning that the company or the property is in a healthy financial position. If it doesn't balance, that's going to mean that something is likely wrong and it's going to require some additional attention. Going into the components a little bit further, let's start with the assets. Assets are going to cover all of the tangible and intangible items that is owned by the company and it has a quantifiable value. Think of them as the valuable possessions that a company holds, items that have a price tag. We're talking about cold hard cash. We're talking about accounts receivables, properties, furniture, and maybe even flashy cars if that's on the books. Additional examples could include like cash equivalents, property values, any fixtures, or equipment. And then on the flip side, you have liabilities. This is the obligations that the company owes to someone else. It's going to include payroll expenses, rent, utility payments, taxes, and any IOUs that are waiting to be settled. And lastly, we have owner's equity or shareholders' equity. This is what's left in the piggy bank after settling all the bills. It's like the company's secret stash for the shareholders. It represents their investment in the business. And it's going to be considered a liability because the company has to fulfill its promise to repay the trust of its investors. When you're looking at the balance sheet, you're going to want to pay close attention to the debt. It's similar to assessing the weight of a company's backpack. You want to make sure that it's not carrying more than it can bear. So remember, the balance sheet is just a snapshot. It's a still frame in the financial story of a company. It provides the nitty-gritty details of a specific moment in time, but it doesn't reveal trends or any fluctuations in the finances. If you want to look at those, you're going to have to look at the income statements and the cash flow statements, which are like sequels to the balance sheet. And they're going to offer a better understanding of the financial journey that the company has been on. And that's all I have for you guys in this part one, if you will, in the underwriting process of understanding what balance sheets are. Tune in next week and we'll go into the other financial statements. Until next time.